Hi, everyone, and welcome to Campground Confidential, a podcast about starting, running, and growing your campground business. I'm Stephanie Puglisi. On each podcast episode, we'll talk to campground owners and other experts in the outdoor hospitality industry. We'll hear stories about what it's really like to own a campground, the good, the bad, and the ugly. From Park Vendor Review, this is Campground Confidential. Welcome to Campground Confidential by Park Vendor Review. My guest today is Johann Schnell, who is joining us to talk about SBA Campground Financing. Johann worked in commercial banking from 2006 to 2019 when he moved into the area of SBA financing. His company works with everyone from startup businesses to enterprise corporations, and he has personally done financing packages for all of the programs that we will discuss today for more than 12 years. Johann is currently at a community development company, otherwise known as a CDC, which is a finance company specifically designed to administer the 504 loan program for SBA in Florida, Georgia, and Alabama. He has financed numerous campgrounds in that region, and today he joins us to share information about financing a campground for those who may be looking to buy or develop a campground property. Welcome to the show, Johann.
Hi, Stephanie.
I'm so happy that you're joining us to talk about the really super fun topic of financing.
Fun for nerds like me.
You like it. I think it's fascinating. There's probably some people who would rather not have this conversation, right? The money conversation, but we're going to dive right in for those folks that are really focused on learning the landscape of campground financing. That's why I invited you on. I think that you're really good at describing this landscape to people who may be just starting to navigate it. So you ready to go?
Ready, let's go.
Okay, great. So first things first, one of the first things you taught me about, because I've never financed a campground before, were the three main financing options that are available to potential campground owners. So let's just go over those three main options first, starting with what most people are probably familiar with, the conventional loan. Do you want to just give us an overview of what a conventional loan looks like, some of the pros and cons of that?
Yep. So when I used to be a banker, where my banker hat business owner comes into my office, tells me that they want to build this campground. I really lay it out in three different options. The majority of financing happens either through conventional and the two SBA options we'll talk about. The conventional loan is the most easy and most common because it's the most easy in cost wise, the lowest. And what that means is a conventional loan is basically a loan between the campground owner and the bank. That's it. And so typically a conventional loan, because it's only the bank, it means that it has a higher level of risk to that bank. And so what the bank will do for a conventional loan is they might ask you to put 30% down and finance maybe 70% of your total project. And with that comes its pitfalls, right? Because some campground owners or people that are wanting to be a campground owner might not have 30% of the total purchase price and things like that. And so for those that do, it's a good option, but everything has its pros and cons. And so with a conventional loan, you're only paying a fee to the bank. And because their cost is a fee plus the interest, you're not paying a fee to the SBA or anybody else. And so that's a benefit. The other benefit is the speed to get the project done. But then on the downside, that entire loan is probably going to have a variable rate, because most conventional loans do. Most small business and commercial lending is done through variable rates. That conventional loan is probably going to have a shorter term, so they don't want to take the risk for too long. And so typically a conventional loan might be 20 years. And so everything has its pros and cons. So if you've got the cash to do it, it's a good option. If you want to preserve your cash, then we'll talk about the SBA options.
Okay, so this is the best option if you are in a position to put a lot of money down.
Mm-hmm.
And if you're in a position to project being able to make payments over a shorter amount of time.
Correct. So your payment, instead of it be broken out to, like, the SBA options are 25 years, your payment would only be broken out into 20. And so
Okay.
you've got to be able to handle a larger payment.
Okay. All right. So for our listeners who can do that, great. You're done with this episode. Go get your conventional loan from your friendly neighborhood banker. All right. Now moving on, because I am in a lot of campground owners Facebook groups and everything, and I see that this is probably not the case for most people who are looking and getting their first campground, at least. They may not have that amount to put down. They may need lower monthly payments while they get the business off the ground. So there's two other options. The first one that we're going to talk about is the SBA 7A loan, right?
Yep.
Same thing. Tell me about it. Tell me what are some of the pros and cons.
With the 7A loan, that's the most common SBA loan out there. And so we're going to talk about two programs, but the 7A is really the most common one out there. So the majority of SBA loans one might find would be this type. The SBA created this program to help the bank do a loan that they might not have done conventionally. And so let's say campground owner comes into my bank. Let's say maybe they have the 30% down, but maybe the combination of their credit or their experience or the numbers, maybe the credit underwriter said, we don't want to do this conventionally. The SBA created this program to be able to assist the bank in taking some of that risk off. And so the program is really insurance to the bank. And that's a big difference between the two SBA programs we'll talk about. This one can finance real estate. It can finance business acquisitions. It can finance partner buy-ins. It can give you cash, working capital. It can finance a lot of things. But some of the pros and cons to it come with the fact that it's an insurance really to the bank and not as much. So like the main benefit to the business owner is that the fact that the bank will do it.
Okay.
And so a lot of campgrounds are on 7A loans because if you're buying a campground, typically the prior campground owner is going to want not just the value of the real estate, but really the value of the real estate, what they've developed, the brand, things like that. And so most campgrounds where you buy the campground might be done on a 7A loan. And so it's common for campgrounds to be on those. If you're building a campground, that's where the 504, the other option, is becoming more popular. And we'll talk about that. But kind of the pros and cons of a 7A. With a 7A, you get 90% financing. And so that's a really big benefit because instead of putting 20 or 30% down, you're only putting 10% down. Now, that's not hard in stone. There are going to be some banks that, even though the SBA says you can do 90% financing on the 7A loan, the bank has the discretion to say, look, for your project, we want 15, but 90% is a possibility. The other benefit is that you go 25 years. And so on the downside of the 7A, that whole loan that you do with the bank is still on a variable rate. And particularly most banks that do 7A lending like to set the rate based on prime. And prime used to be a really good marker when it was at 3.25 for all those years. And then since a little bit before the pandemic, it shot up where now it's 8.5. And so that's a big difference in pricing that a lot of campground owners that are in a 7A loan are probably feeling right now.
And we're going to hold that thought, everybody listening, right? Because we're going to return to that as being one of the sort of markers in today's economy for you, especially what you're seeing campground owners do, that these conventional loans and these, 7A loans have these variable interest rates that are probably impacting people's bottom lines a lot this day. So hold the thought. We'll come back to that and what you're seeing in the market based on that. But let's move on to the third type of loan, the SBA 504 loan, which is your wheelhouse these days, right? So tell us about it, pros and cons, you know the drill.
Yep. So the reason why there's another program that the SBA offers is because the 504 is specifically seen by SBA as a development loan, as opposed to an assistance loan. It's seen as a development loan. And so this is for the business owner, but not for a lot of different things, specifically to buy their commercial real estate, the commercial real estate that business owner operates inside. Campground is perfect because the campground owner is buying the real estate for their campground to operate inside of it. And so the 504 is limited in the things it can finance. It can only finance real estate. It cannot do working capital. It can also finance improvements to that real estate. And we could talk about how a project typically looks. But the basis of the 504 is that the business owner is able to buy their real estate, whereas the 7A, they can do a lot of different types of things, including real estate. The With the 504, it's a little bit more complex because with the 7A and with the conventional loan, you only had one mortgage. You buy your campground, you have a loan with the bank, whether it's conventional or whether it's 7A, it's one loan. You pay the fees on that one loan and you have one payment on that loan. The 504 is a little bit complicated because you actually have two mortgages. You have a mortgage with a bank that wants to participate in buying the campground, and you have a mortgage with the SBA. The benefit, the real reason why the SBA created this program is because that SBA loan, the second mortgage, fully fixed for 25 years. And it's below market rate too, because the SBA has companies like ours, we're called CDCs. We go to the bond market and we're buying bonds based on owner occupied commercial real estate. And so the bond rate is lower. So therefore your mortgage rate is lower. And so you have two mortgages. You still have to work with a bank. The bank will probably still offer a variable rate on that first mortgage. They're in control. The SBA says we need the bank to help, but we want to offer fixed rate financing too. And so the bank is important. When I was the banker and I had that campground owner, I would typically show them all three options. And I would say, here's what a conventional looks like. Here's what a 7A looks like. And here's what the 504 looks like. Here's what I control as your banker, first mortgage. And here's what the SBA offers on the second mortgage. It can still be 90% financing on the 504 program, except campgrounds. There's a little bit of a nuance. If they have a pool, if they're on a lake, there's certain things that the SBA will see that campground as a special purpose facility, meaning it can only be a campground. And the SBA on the 504 program asks for a little bit more money than in the 7A, more money down. And so my typical campground financing is either 15% down or 20% down. So even though it's a little bit more money down than the 7A, it's still less than conventional. And we're offering a fixed rate.
So how much, right? It's that two mortgages going on here. How much can be in that 504 loan? Is there a cap?
Yeah, that's a really good question, which is why the program's popular. The SBA generally for both programs, you can only borrow up to $5 million. And so if you do one 7A loan, you can only get up to 5 before the bank is taking on more risk than what they're covered for.
Mm-hmm.
And so if you have a $7 million campground that you're going to build, that bank looking at a 7A, they're really looking at 5 covered under the SBA program and 2 that's not covered by the SBA.
Mm-hmm.
On the 504, that $5 million cap is only on that second mortgage. And so you could have a $15 million project and the second mortgage is still under that $5 million.
And then if that's the case, say you had that $15 million project, 5 of it is the other 10. That has to be fully a conventional loan, or could it be a conventional with a 7A?
You can combine.
Okay.
So like, for example, we have a big project right now and a campground, and it's about $9 million to build this campground. And so their budget looked like the purchase of the land, the purchase of all the construction costs, the architect, engineering, impact, zoning, all that soft costs. But then there are things about the campground that are not able to be included. So for example, the campground owner is going to have to hire staff and train them before they open their doors. They're going to need to do marketing. They're going to need some working capital is what I'm saying. They're going to need to have some cash to be able to do things to open the campground. So the 504 will finance the building of the campground, and we might do a piggyback 7A for the working capital to help the business owner have stabilization for the first 2 years while they're building that occupancy.
Okay, that makes a lot of sense. Yeah. So you can really move between the programs depending on what part of the business you're focused on financing, and you can pick the best program for that particular part of the business.
Yep, there's certain times when a project comes to my desk, even though my company, all we do is we represent the SBA on the 504 program. So we do that second mortgage and we partner with the banks to do it. And so all we do is 504 and we represent the SBA. So we're Switzerland when it comes to banks. But when a project comes over my desk because somebody looked up the 504 program, they're like, wow, it's 6% fully fixed. It's really good. They'll bring it to me. And sometimes it's a better 7A because you have to understand what that campground owner wants to do. Some campground owners want to build it, develop it, and then move on. And so one of the things, the 7A only has a 3-year prepayment penalty period. And so for a person that wants to move out of that property in 5 years and sell it after it's developed, the 7A might be a better option. The 504, because we're going to the bond market to give you a low rate, it has a 10-year prepayment penalty period. So there's pros and cons to everything. It's all about what that campground owner wants to do. The 504 is really good for the campground owner that wants to build it and hold it and maybe have
Okay.
multiples.
Okay, that's really good insight. But I'm going to ask you a little bit of a tough question. If someone is looking to get all of those options, like you said, as a commercial banker, you would lay out all of those options. Or now sometimes you say to somebody, hey, a 7A would be better for you. Um, who should people go to first to get that advice? Because sometimes I think people are worried that the banker or the financer isn't going to give them the best option. They're going to give them the option that's best for them, right?
Yep.
In terms of the money you make off of the loan. So, like, what order do you think is the best for people to kind of start to pick this apart? Should they go to like a resource like yours and reach out to someone like you if they're not in you're in Florida, Georgia, Alabama, if they're not in that region,
Yep.
somebody that deals with their region, or should they start at the commercial bank? Like what do you think is in the best interest of the campground owner?
I always say that having a relation, like when you're a business owner, and I've been doing this for too long now, the the business owner is usually very, very, very good at what that business core competence is going to be. So, for example, if they're a campground owner, they're really good at hosting people and making them feel welcome, right? But what a lot of business owners experience once they jump in is running the business, being a manager, handling HR, legal, all that stuff is the part that they don't teach you, right? And that's 100% what I hear all the time. And so, as a business owner, the best advice I can tell you to answer this question is you've got to have a really good banker. And if you don't have a really good banker, you have to go out and find a really good banker because walking into the branch and asking questions to the branch people, and I love my branch people when I was at the bank, but they're not equipped to handle
Right.
advisory relationships. And so the short answer to your question is start off with your bank, but test that banker whether the appetite of that bank is really to finance this project. Because, for example, you might walk into your bank and they're not in the business of financing a startup campground, or they're not in the business of doing a ground up construction of a campground. Maybe you have your campground with that bank, but maybe they didn't loan you the money. Maybe it's just where your banking is. Maybe you have a 7A loan with another lender, but you have your banking relationship. And when you go to do loan 2, your bank might not be equipped to do it. And so there's not a one size fits all, but I definitely recommend, I'm using this time to tell you, have a good banker, have a good CPA. Those are usually 2 really good starting points. Usually good bankers, they know what their bank will do and not do. And when they know what they don't do, they also have relationships with other bankers that do say yes to their customers. And so the CDC, we're a good resource because we're not a bank and we know all the banks. And so typically when a project comes directly to me, I've already been working with banks that are in that, for example, if I need a self-storage facility, then I know what banks are participating in that industry.
Right.
If
Right.
it's a restaurant, I know what banks are doing in restaurants. If it's a campground, I know what banks are working in campgrounds right now. And so the CDC is a great starting point too. Um, but what the CDC sometimes we're looking to make it into a 504,
Right.
and
Right.
so sometimes it might get clunky. Like I had a project the other day where it was a better 7A based
Hmm.
on all the questions that I was asking the client. It was going to be a better 7A.
Yeah. And you're a good guy and you told him that, right?
Yeah.
Great. All right. So thank you for that. I think that that's really helpful. I think it's probably a little like personal finance, right? If you've got, an advisor who's like, don't worry about it. You're fine. I'm taking care of it all. And like not answering your questions and not explaining to you, like those should be red flags, right? Like, and I think that that's probably the same in this case. If you had a banker that's not really laying out all your options and talking to you about the intricacies of this decision, that's probably a red flag too. So education is key, right? For a really
Yep.
good advisor in any of these areas. All right. So let's move on to just an overview for potential owners that are listening to this. Like, what are the typical bones? You referenced this a little before, but let's just lay it out. Somebody's not just borrowing for land, right? As you mentioned, what are all of the components that people need to think about financing when they're entering their first campground project?
So if they're buying an existing campground, it's a little bit different. If they're buying an existing campground, they can use the programs, whether a 7A or 504, they can use the programs to purchase that business and that campground. And usually if the property needs improvements, that's usually a good time to go ahead and work those improvements into the loan, because if those improvements will be included in that mortgage, so they'll be broken up into 25 years. If you are worried about what you can afford and you just buy the campground and you say, oh, I'll do these improvements in 2 years and 3 years, it'll be really hard for a bank to amortize that for longer, maybe than 5, 10 years afterwards. So if you're buying, focus on taking over that campground. What are the things that it would really benefit that campground from the get go? And that's that side. When it's construction, the through our program, the ground up construction of a campground is really more beneficial for a 504. And I'm not saying that just in a biased way, but you're taking more advantage of interest expense. You're taking more advantage of what you can fit under the SBA cap. So if you're doing a ground up project, you probably should focus on talking to your CDC that covers the state that you're doing that campground in. So like, for example, we do Florida, Georgia, and Alabama. So any campground in that state, we can help you out. But if you're in New Jersey, you will look for a CDC that's in New Jersey. And when you do that, a 504, you can include the purchase of the land. You can include all the costs that it takes to turn that raw land into your campground. And so typically my campground projects look like a lot of soft costs, engineering, zoning, impact, civil, surveys, geotech, a lot of soft costs, like basically people coming in and studying the land and telling what that general contractor is going to be able to do. Then you have the hard costs of the project. So you have all the site prep, you have all the electrical, you have all the utilities, you might have the the main building where you're going to have like arcades or offices, whatever. And so all those are construction hard costs. But one of the other things that the 504 can do, which is a really good benefit, is during construction, the campground's not operating. And so you're going to be drawing on these loans, but the campground's not receiving any income yet.
Mm-hmm.
The SBA allows you to borrow that interest only expense during that construction period. And so typically if the cash flow, if we can work it, we'll try to include that interest only payment during the ramp up period too.
All
And
right.
so that's the bones, and then closing costs to do all of that.
And you really did mention this before, but just to put a fine point on it, you mentioned that the 7A can provide working capital in a way that the 504 can't, right?
Right.
So
And so,
that may be a flag that you need to go in the 7A direction and not the 504.
or like, for example, if the working cap on a campground, it's a little bit different because the amount of working capital relative to the building, the building of the campground is a big difference. And so, for example, if you're doing a $7 million construction of a campground, but your working capital only needs to be 200,000, don't put that entire thing into one 7A where you have a variable rate. Do the 504 for the things that you can do,
Right.
and then have like a little 7A loan. for that working capital piece.
Got it. I like that. I think that's a big takeaway for me in this episode talking to you is that you can kind of pick and choose what the best is for each part of your project. Don't just get stuck in one thing that's not really suitable for all of the complexity of your project. Well, let's move to talking about the current landscape. When we were chatting about this topic, you really mentioned that this is a pretty dynamic time for you in this, basically because of the way costs, right? The inflation, interest rates are impacting very specifically the campground financing business. So, do you want to just talk about some of the things, some of the impacts you're seeing in this space?
Yeah, there's two, just like with everything else that we're dealing with, interest rates going up and cost of inflation going up. When it comes to campground owners, let's just talk about construction, right? The cost to build a campground these days is very different than it used to be 4 years ago. In certain areas of the country where campgrounds want to be tends to be in areas where there's a lot of demand for people moving to, like Florida, for example.
Mm-hmm.
The cost of a lot to do a campground is different than what it used to be. And so the project sizes on our side have gone up, which puts pressure because at the end of the day, the campground can only have so many sites. It can only turn them so many times. And so there's only so much revenue a campground could have, right? And so the cost of construction has definitely changed the landscape on campground financing. You used to be able to do a 7A only under 5 million because building a campground might have been only $5 million. But now it seems like most campgrounds tend to be the bigger ones tend to be in that $7 million, $9 million range to build. So that's something that's important.
So you're seeing more bundles than you would have to before, where you'd have to kind of piece out the loan into these different types.
Yes.
Okay. All right.
And
And what
then,
about these interest rates? This was really interesting to me, the difference between the variable and the fixed.
yeah, so this is something that probably several campground owners might pull up and they realize, yeah, now I understand why this has been going up. So when you sat down with your banker at, let's say, 2017 and you bought your campground, they might have told you, hey, the loan that we're giving you is going to be variable. It's going to be based on prime, and it might be prime plus two. And at that time, prime plus two was around 5% because prime was 3.25 plus that 2%, you're at 5.25, maybe 5.75 if they priced it a little bit higher. And you could make your numbers. Everybody was happy. Five something is not that bad. As prime went up, now that same loan is now in the 10%, 11%. And so there's a lot of and not just campground owners, it's a lot of people that are with a 7A loan that their payments have really drastically changed. And so that's something that really needs to be considered. SBA, understanding that, has changed the rules. You used to not be able to refinance an SBA loan with another SBA loan, but they changed the rules a few years ago to try to help those 7A loans that maybe are truly mostly real estate and move those over into a 504. And so we've been busy, not just with the new purchases and new construction, but also with a lot of 7A owners that are wanting to try to put it into the 504 to get the lower fixed rate. And I explain that because even the same bank, so let's just pick on any bank, if they do a 7A loan, maybe their pricing has to be based on prime because that's their credit policy. But if that same bank does a 504 to that bank, that first mortgage is really a conventional loan and it's not a 7A loan. And so that same bank could price that same client a lot lower.
Right.
And so that first mortgage with that same bank might be in the 7% right now, 8% right now, where that 7A loan they have is, pushing 11. And so the amount of interest you save moving it into a 504 is significant. It involves refinance.
I find it so interesting that you're busy refinancing while the refinancing industry for everybody else is completely shut down. Nobody's refinancing on, home mortgages or anything like that. And you're over here, doing a steady clip of campground refinances because of this type of loan. So I
Yeah.
found that surprising, and I thought maybe some other people might find that interesting too. All right. So thank you so much for all of that information about financing campgrounds. But see, Johann, you're an actual camper, right?
Yeah, I am.
Okay. So we're going to switch things up a little bit. And for the lightning round, I'm not going to ask you finance questions because I think you just answered a lot of finance questions. I decided that for our campground owners that are listening, they could hear a little bit from an RVer and a camper and have lightning round questions for that. All right. So you ready to go?
All right, scared.
All right. All right. How long have you been camping?
Since 2016,
All right. Who do you camp with?
my wife and my kids. Fort Wilderness is our favorite place to go. So unfortunately, Florida, Georgia, and Alabama, it's not just my work footprint, it's also my camping footprint.
That was my third question. What was your favorite campground? Okay, check. Fort Wilderness. How could Fort Wilderness not be your favorite campground, especially when you live that close by? We're very jealous of your proximity to that. Okay, what is a non-negotiable amenity that you look for in a campground?
Water access,
Ooh, I
whether
like
it's
it.
the beach or a lake or a pool.
All right. What amenities do you absolutely not care about at all?
Laundry room,
Good one. Who wants to do laundry on vacation? All right. What is the smallest or least expensive thing at a campground that makes you unreasonably happy?
can you repeat that?
Yeah, sure. So, what is the littlest, smallest detail in a campground that makes you unreasonably happy? What do you just love that costs nothing for campground owners to give you?
The location. It's
Location, location, location. That's all
yeah.
you care about. All right. What is the number one thing that gives you the ick about a campground?
How dirty or unkept bathrooms are, or in general the sites. If sites are unkept, red flag.
Big red flag. 3 words that describe what camping means to your family.
Turning off. Like in this world of finance, and my wife is a pharmacist at a hospital, it's being able to just turn off.
Disconnect. I love it. All right, campground owners, we just gave you a little mini survey from a camper right to your ears at the end of this finance episode. We brought it all back to the actual meaning of all of this, which is disconnecting with your family at a clean campground with water access. And that's heaven on earth for you. Thank
Yeah, I
you
mean,
so much.
it's not just for wilderness. Like we do a lot of city and state parks because it's Florida, right? And yeah, just clean sites, clean bathrooms.
I love it. So simple, so easy to make your guests really happy most of the time. Thank you so much for joining us at Campground Confidential by Park Vendor Review, Johann. I really appreciate your expertise, and we'll have you back when we have more finance questions we need answered.
Thanks for having me.
All right, see you later.
See ya.
Thank you so much for joining us for this episode of Campground Confidential from Park Vendor Review. If you are a campground owner, operator, manager, or employee, make sure to sign up at parkvendorreview.com to search for vendors, read and write reviews, and access our library of resources. If you are a vendor in the outdoor hospitality space, head over to parkvendorreview.com and claim your listing today. We'll be back with another episode of Campground Confidential, but until then, visit us at parkvendorreview.com, where we make vendor decisions simple.